Hello and welcome to Financial Future. I have some exciting updates for you today. The Federal Reserve has just made a significant announcement, stating that there won't be any increase in interest rates at this time. The latest update comes following the conclusion of the November 1 FOMC meeting, where the Fed funds interest rate remains steady at 5.5%. While this was expected, there are some crucial points to consider. The Federal Reserve has raised interest rates a staggering 11 times since the last year, gradually moving from 0.25% to the current 5.5%. This rapid pace of rate hikes over the past 40 years has had a significant impact on various aspects of our financial landscape. As a result, borrowing money has become considerably more expensive. For instance, mortgage interest rates have soared to 8% for a 30-year fixed term, marking the highest rate in 23 years. Additionally, home equity lines of credit have hit 9%, the highest in 2 decades. Moreover, the average credit card rate has surpassed 20%, an all-time high. Auto loans have also been affected, with the average rate climbing above 7%, the highest seen in 16 years. Consequently, many Americans are finding it challenging to finance a car at these elevated interest rates, leading some to keep their vehicles for longer periods. The primary objective behind the Federal Reserve's decision to raise the Fed funds interest rates is to make borrowing more expensive for both consumers and businesses. However, it's crucial to note that the impact of this isn't limited to just the interest rates. If the interest rates on government bonds rise, it would further escalate the cost of borrowing. Interestingly, the interest rates on government bonds are currently on the rise, indicating that the Federal Reserve might have less intervention to do. This is one of the key reasons why the Federal Reserve chose not to increase interest rates today. The upcoming press conference with Jerome Powell will shed more light on the matter, including discussions on U.S. Treasury yields and the Federal Reserve's plans moving forward. Expect insights into core services PC inflation, which has remained stubbornly high at 5.5%, well above the 2% target. Inflation, particularly in core transportation, food services, and recreation, has posed significant challenges. Jay Powell is likely to express concern over this inflationary trend, emphasizing the impact on the working class. While he may express sympathy for the public, it remains to be seen how the Federal Reserve will navigate the current economic landscape. Furthermore, the housing market and various industries have been significantly affected, leading to pressure from various associations, institutions, and even politicians urging Powell to consider cutting interest rates. With the market anticipating a potential Fed pivot around late Q2 or early Q3, it's clear that the economic landscape is undergoing a significant shift. While it's expected that lower interest rates and increased money printing will eventually follow, the interim period may see some challenging times, particularly for businesses and industries built on the premise of low interest rates. As we move forward, it's important to brace for potential market turbulence and economic challenges. However, keep an eye on the horizon for the eventual shift toward lower interest rates and increased liquidity. Stay tuned for my next video, where I will delve into the press conference highlights and provide in-depth analysis. Don't forget to subscribe for more insightful updates. Thank you for your continued support, and have a fantastic day.